This is FRM Part 2, Book 3, Operational Risk and Resiliency, and the chapter on capital regulation before the global financial crisis. In reading that chapter title, you might think that this is going to serve as a history lesson, and in large part it does. But it makes some sense then that there has to be a chapter called Capital Regulation After the Global Financial Crisis, which of course we'll get to sometime in the near future. This chapter was written by Mark Carey from the Risk Institute, and we've read a couple of his chapters before. And this is a well-written chapter, and it gives tremendous insight into the state of operational risk well before the 2008 financial crisis. In fact, the beginning paragraphs serve as a really good history lesson. And I don't mean a history lesson going back decades. I mean going back maybe centuries. And Carey suggests that businesses in general, but of course financial institutions in particular, base their success on their ability to convince the consuming public that they had a good product. And so for financial institutions in particular, it was quite a challenge, because when you go into a financial institution, you're not going in to buy a gallon of milk or a computer or something like that. You're buying this financial service. So confidence and reputation play a big role. I always tell my students and give them the following example. I say, all right, suppose I'm Jim and I have a bank and I call it Jim's Rock of Gibraltar Bank. And the name of that bank suggests all sorts of things, right? The Rock of Gibraltar has been around for, I don't know, thousands of years, millions of years. But then I say, compare that to a bank, and let me call it Jim's Sandcastle Bank. And even if I spend hours sitting on the beach building this intricate sandcastle, sooner or later that wave is going to come and crash it down. And so that's really the sense of what the beginning of this chapter tells us, is that we want to make certain to learn from history, right? To learn from history and build Rock of Gibraltar financial institutions and not sandcastle financial institutions. And so that's what these learning objectives are all about. We're going to explain motivations for introducing the Basel regulation. So we're going to go back. We've talked about this regularly. We're going to go back to that first one, which occurred beginning in the late 1980s. Look at this second one. I love the wording of this. We want to explain the calculation of risk-weighted assets and capital requirements. I have a couple of math examples for that one. So we'll look at some things that occurred back in the 1990s. We'll examine some of the changes then to Basel II, including those three pillars. Then we'll look at some kinds of approaches for capital. And before we move on to the slide deck, I want to give you a sense that, what we're trying to do is we're trying to come up with some kind of a metric, some measure, like a ratio that is meaningful. I mean, we can clearly we can put a debt equity ratio in there, and we can take market value of debt and market value of equity, and we can come up with some ratio. But and let's go back up and refer to that second learning objective, unless that ratio is risk weighted, it's probably not as meaningful, especially for financial institutions. So let's go ahead and get started here. Status of the banking sector before the crisis. All right, no strict regulations. Success or failure was hinged on an institution's ability to convince clients to use its services. This is what I was talking about earlier. So financial stability demonstrated through huge amounts of capital. All right, so let's just make sure we understand where we are in the balance sheet. We're on the bottom right-hand side of the balance sheet. So what's the goal of the business? Maximize shareholder wealth. How do we do that? By swelling the retained earnings portion of that capital. And how do we do that? Well, we invest in projects that have positive net present values. So for a financial institution, this means making loans that are going to show up over on the income statement as cash flows. Impressive bank buildings, and so client confidence was critical. Loss of confidence would trigger a crippling run I'm guessing that you guys have had some kind of a finance textbook in which there was a picture in, let's say, 1933 or 1931, where there's a picture, an old picture of a bank, and then there are people standing around the bank, and they're going around and around and around because during the Great Depression, there are lots and lots of problems, but runs on banks was, of course, just part of that. Now look at that third block point here. Institutions crafted the first set of regulations to save each other from insolvency. All right, this is one of the portions that we talked about way back in the beginning of these videos, where we talked about ethics and and the FRM commitment to ethical responsibility and ethical decision making. So this is kind of self-regulation. And that's probably where lots of these industries started, with self-regulation, where institutions looked around and organizations looked around and they said, you know what, we need to get together and try to figure out how we can move forward together. Even though we're in competition between and among each other, we need to move forward together to ensure that we're going to be around sometime in the future. Now, of course, the problem with private monitoring and protection is that there's typically a lack of financial support, in that some of these private entities, let me go back here, I think I forgot to talk about these central banks down here at the bottom. Central banks, of course, were critical in this self-monitoring, but central banks, they can't print money, although these days somebody might seriously argue with that particular point. Look at that circle point. Financial crisis would usually impact the economy as a whole. I learned about this when I was in graduate school. First time I ever heard this word, one of my professors used the word contagion, and how a financial crisis that is local, maybe in some region or some specific part of an industry, could spread. It was contagious throughout the entire economy. Now, when historically we had these runs on banks and recessions, and notice that we have a slash for depressions going all the way back to the 1930s, then this was not confined to just the local economy. So this went throughout the world, right? But of course, coupling this contagion was the fact that economies were relying more and more on each other, to the point where we are today. I mean, lots of cases with trade agreements. You don't even know that there's a geographic boundary between countries and economies. All right, so let's start with a little bit of a specific history lesson. Let's go back to the 1980s. So if you some of you were old enough to remember the 1980s, I hope. In the United States, these were the years of the Ronald Reagan presidency, and the economy was characterized by lots and lots of high economic growth. Now, it was always also characterized by high amounts of government spending. Remember, these things were called the Star Wars, and this had everything to do with the United States position as it relates to other countries in the world. But anyway, back in the 1980s, there were a group of these 10 nations who agreed upon the set of minimal capital requirements. Remember, a few chapters ago, we talked about this need for a buffer or a cushion. And so now we're extending that to include some kind of a ratio that can be applied between and among banks of all sizes and of all risk profiles. I think we're up to about 62 nations that have agreed on these minimum capital requirements, but it started out with 10. And so it established this minimum capital standard that was cross-border financing, and it leveled the playing field so that some banks were not penalized unfairly versus other banks, so that we can, remember, let me do this again, move the industry forward as one unit. Of course, let's not forget, these banks are competing against each other, right? But it's important to move forward. All right, how about Basel I, components of capital? And we've seen this in a previous chapter. So let's go back to our balance sheet. We're on the or on the bottom right-hand side of the balance sheet. And what I want to do is I want to go ahead and start at the bottom. So Tier 1 capital, which was designed as a measure of capital so that solvency can be preserved. We start with what the accountants historically just call retained earnings, but for a financial institution, we call that disclosed reserves. Remember, those retained earnings come from the income statement. So if the business is successful, then there are lots and lots of cash flows then that will get transferred over to the equity portion of the balance sheet. And then we'll move up to paid in capital or paid up capital, and this is the equity minus the goodwill. So remember that goodwill can occur only when one bank takes over another bank and pays a little bit more, or maybe a lot more, or maybe a substantial amount more than whatever the fair market value was before that kind of a transaction. So that's Tier 1 capital. And what Carrie does for you in the relatively beginning of this chapter is say something like, hey, this, if you go back to the late 1980s, here's this Tier 1 capital requirement greater than 4%. Look at the bottom left of the slide. That this sounds pretty rudimentary today by today's standards, but he mentions that this was pretty clever thinking. It was pretty state-of-the-art, and it was a way to standardize these capital requirements. Of course, that Tier 1 capital and those ratios then led us to where we are today, which we'll get to when we talk about that chapter called, regulations after the financial crisis. That takes us over to Tier 2 capital. So let's go ahead and start at the bottom. So, Tier 1 capital is the way bottom of the right-hand side of the balance sheet. Now we're moving up to the near bottom. So we have hybrid instruments, subordinated debt, asset revaluation reserves. This is really kind of a cool accounting thing where you have an asset over on the left-hand side of the balance sheet. Of course, it's a long-term asset. And historically, and from an accounting perspective, this is like machinery, things like that. And when it gets depreciated or over-depreciated, or, let's suppose we have a building that, for some reason just starts to crumble. Well, you have to write it down. So we have all these asset impairment rules, but asset revaluations are kind of like the opposite. This is when the asset increases in value, and so you want to reflect that over in capital. If you have a, let me just take a simple example. If you have a mortgage loan over here, and when you made the loan over here to this individual, it was a young couple, and they just started their jobs. They didn't have any credit. They didn't have any parents who were going to lend them money, or they had no inheritance, and they had no cars, and they had lots of college debt, but you made this loan to them, and now after 5 years, they have great jobs, they make millions of dollars a year, and so you might want to revalue that asset. Now that's a really simple example, and it probably doesn't meet all of the accounting standards, but you kind of get the sense of what I'm saying. And then continue to move up. We have undisclosed reserves and then general loan loss provisions, and so Tier 2 capital should be greater than 8%. All right, so you get a sense of what these 10 nations got together in Switzerland, and they decided 4% and 8% are acceptable measures. By today's standards, we may not like those because lots and lots of things have changed since then, but this was a really, really good first start. Now, this concept of a risk-weighted asset came about in the 1980s because all assets are not created equally, right? So you might have a mortgage loan to this young couple, right, which was pretty risky, versus a mortgage loan to, let's say, my wife and me, who are in our mid-50s, and we both have good jobs. So even though we both might have a $100,000 mortgage, well, for capital requirement purposes, those two mortgages probably shouldn't be valued at $100,000. So we need to make some adjustments, and so that's what that first block point says. A risk weight is applied to each on balance sheet asset according to its risk. And the Basel I committee came up with these rates here. So 0 to 100%, I mean, that makes sense. Let's start at the bottom. So these exposures, commercial or consumer loans, this means that, boy, we should attach 100% because these are risky. These are the highest risk. And go all the way back to 0 if we've invested in some kind of a government bond. And the chapter talks about this, the Organization for Economic Cooperation and Development governments. So these are all, advanced governments. And when they issue bonds, you can assign a 0% weight because they are essentially risk-free, default risk-free. Can I say essentially? Can I say virtually? I don't know. There's some adjective that I ought to put in front of that one, in front of that word. And then, of course, in between, you have 20% and 50%. Now, let me show you how this works. Suppose we have an Australian bank with, let's just suppose we have these different kinds of assets going down the left-hand column in the following book value amounts. And so if you sum those, you get Australian dollars of 1,050. But the risk-weighted assets, if we multiply each of those, the 400, the 300, and the 250 by, and let me just go back here really quick, by the appropriate weights here, we only get 600 of Australian dollars. So think about what that means. If we're going to use 1,050 as a denominator versus the risk weighted, which incorporates the probability of default, or at least some measure of the possibility of default, then we're only going to use 600 in there. Those ratios back here, so these ratios back here are going to be completely different. So notice in the denominator, we have the risk-weighted assets, 4% and 8%. So we want to divide by, where am I here? We want to divide by the 600 versus the 1,050. Even though from an accounting standpoint, we have the 1,050, but from a risk standpoint, we only have 600. Now, we've spent lots of time talking about off-balance sheet items. Remember, we use that term special purpose vehicles. So what happens if we throw some assets into this other thing? We call it a special purpose vehicle, off-balance sheet financing. Well, we can't just ignore them, right? Just because the accountants call them off-balance sheet doesn't mean that their default or their success is not going to impact the future of the financial institution. So we need to consider those. What we need to do is we need to come up with this credit equivalent amount. What we're going to do is we're going to convert those off-balance sheet items into on-balance sheet equivalents so that we can compute these capital ratios and risk-based capital that reflects the riskiness of on-balance sheet and, of course, off-balance sheet. And the nature of that third party is going to result in 50% for corporations and 20% if it's OECD bank. Now, one way we can do this is through something called the current exposure method. And this is a relatively simple calculation. So this credit equivalent amount is going to be the maximum of 0, right? If we have some special purpose vehicle that contains credit default swaps or some other kind of a derivative, if its value is positive. So if it's 0 or negative, then we're going to assume 0. But the max is going to be that current value plus some kind of an adjustment. So look at the plus over there. And the textbook tells you and uses the notation, D times L. So there's some kind of a premium or an add-on factor times the principal amount. And here's a really simple example. So there are some coefficients in the table above. And the example below, $100 million swap, 3 years of maturity, worth $5 million. So we have this $5 million that is somewhere over there in an off-balance sheet item. So what do we use? Do we use that $5 million or do we use some other amount. And so, of course, this credit equivalent amount, right? We're transferring this $5 million from the special purpose vehicle or some other off-balance sheet account. We're converting that over to an on-balance sheet amount. And so all we're going to do is take the $5 million plus, where am I? So it's 1 to 5 years. It's an interest rate swap. So that's 0.5, right? 0.5 times the 100 million. So that gets me up to $5.5 million, right? The credit equivalent amount. And then we need to make the adjustment here. Let me go back. Here we need to make the adjustment, right? 50% if it's a corporation, 20% if it's a financial institution. So there we are, assuming the counterparty is one of these banks, then that RWA is just 1.1 million. Risk-weighted asset 1.1, which translates from a swap that's worth 5 million that has a credit equivalent amount of 5.5 million. So you see how we're going from over there to over here on the balance sheet. The second way to do this is called the original exposure method, and this applies only to interest rate swaps and other interest rate contracts and foreign exchange contracts. And so all we're doing here is the exact same thing that we did before, but we have some different kinds of coefficients and a little bit different formula down there, but the math works out the same. Now let's go ahead and ask the question about what are we doing to combine on balance sheet and off balance sheet. So we've got these risk-weighted assets. So forget about that table up there on the top for just a second. Let's go ahead and look at this equation. So the risk-weighted assets, look at the left-hand side of the plus sign and to the right of the equal sign. These are the on-balance sheet items that we talked about before. And then over to the right-hand side of the plus sign, these are the off-balance sheet items. So the total risk-weighted assets are going to be the sum of the on-balance sheet items and the sum of the off-balance sheet items. And that should make perfect sense. And there are some examples of some special categories: guarantees on loans, warranties, loan commitments, etc., etc. Now, we've spent some good time talking about netting, and I was fascinated to learn, I did not know this, not a common practice prior to 1987. Now, in fairness to me, I'm not a perfect history guy, but I started my PhD program, somewhere around that time period, a couple years later maybe. But I'm surprised that didn't come up, or maybe it did, and I just didn't remember it. Now, remember in a previous slide deck, we had these really cool illustrations showing the process of netting. And, remember, we had all these different parties. We had arrows going back and forth and up and down and sideways. But then with netting, we just had a bunch of really, really neat arrows. And so really it simplifies our life. So what we've got to do here in this slide is we need to take a lesson on how to go from this credit equivalent total if we have a bilateral netting agreement. All right, so let's go ahead and look at those two equations. This is the one we did before. So the credit equivalent amount change or modification went from summing, the values, right? Forget about those off-balance sheet items that are negative. So it's, essentially the market value of these items plus some premium, right? So we changed that to consider the effect of netting. And so what we're going to do now is we're going to do, something similar. So we're still going to sum all of those positive positions that we have, but then we're going to adjust our off-balance sheet items by 40% and then 60% multiplied by that net replacement ratio. So that credit equivalent amount modification it's designed to reflect the possibility and the likelihood, of course, of netting. All right, so where are we in our history lesson? So we're up in the 1980s, and then we have this official Basel I in the early 90s. So then we have a 1996 amendment. Requires banks to measure and hold capital for market risk for all instruments in the trading book, including those off balance sheet. All right, so what does that sound an awful lot like? That sounds an awful lot like. Now, forget about authoritative bodies. Just think about you and me as regular old investors. And what we want to know is we want to know whether or not this financial institution is undervalued or overvalued, right? Now, we could be sophisticated investors like a mutual fund or a pension fund, but we're trying to value this. And so all we're asking for is transparency. So that's what this amendment, from my perspective, is designed to do. It's designed to say, all right, here's the on-balance sheet stuff that we can clearly observe, but what about that off-balance sheet stuff that is placed maybe in a footnote in the 10K, and maybe the footnote is incomplete, maybe it's inaccurate, maybe all these kinds of things. What we want to do is we want to make sure that we're valuing these things properly. All right, so you can do this one of two ways: standardized method approach, which standardized measurement approach, which we're not going to like, because look at these block points down here. Separately assigns capital to each item in the trading book. I mean, that in and of itself is probably okay, but let's go back to these different business lines and silos that we have. And so each trading book, may be inside of a different silo, and we're going to assign capital there, right? We like the umbrella, we like all that stuff. So by definition, then it has to ignore correlation, probably inside of that silo and clearly outside of that silo. And look at the last block point, usually applied by banks with less sophisticated risk management processes. So what have we been doing, over these last group of slide decks and recorded videos? We have tried to increase our sophistication in identifying risk and quantifying risk and managing risk. Now, the internal models approach is going to be much more appealing to you, mostly because it not only recognizes correlation and by implication then all of the diversification benefits, but we're going to go back and we're going to use a value at risk, and we're going to convert that into a capital requirement. So remember that we initially talked about how to compute value at risk, and then we talked about the interpretations of value at risk, and then we talked about the limitations of value at risk, and then we talked about how to resolve some of those limitations. And we're still kind of in the process of figuring out how valuable this value at risk is, even though it has a lot of value, but it doesn't have perfect value. And so all we're going to do is we're going to use this market risk equation down here at the bottom, and we're going to take the maximum of the value at risk from yesterday, and we're going to compare that to the average value at risk over some previous time period. Now, the Basel Committee decided on 60 days, and based on a multiplier that can be not less than 3. And so this incorporates value at risk, and so it gives us a sense of market risk. All right, what are some of these problems? We always talk about advantages and disadvantages. And what are some problems? I like to think of them as challenges, but clearly, this Basel I was a first attempt, and that's what it was. And that's why we've had 2 and 3, and we'll probably have 5 and 10, before it's all said and done. Here's one of the big issues. Regulatory arbitrage was rampant. And now one of the simplest of all examples of regulatory arbitrage was the difference in tax applications of maybe capital gains, or in particular dividends. And there are ways that you could have ownership of a corporation. If you lived in one country, your dividend tax payment was different than if you lived in a different country. And so there was this particular form of regulatory arbitrage, and there are lots of other examples as well. And so look at the second block point. There was room for capital manipulation. There's no way that phrase can do any of us any good. If we shift between on balance sheet with different weights, throw them over to the off balance sheet, maybe we'll securitize them, maybe we won't. But what this does is that, remember what I said a few slides ago, we're interested in transparency while we're continuing to improve transparency. Well, there are pockets of non-transparency that probably were created. So look at the third block point. Too easy to hit the required capital levels. Okay, so that makes sense, right? Financial institutions are run by smart men and women, and so they're going to do their best to meet these capital requirements, and then maybe shift some things around so maybe it looks like the financial institution is operating in a better financial position than what maybe it truly is, or not reflective of its level of risk. All right, so of course, then, we've got these problems with one, so we're going to come up with some solutions in two. So now we have three pillars: minimum capital requirements, then supervisory review, and market discipline. All right, so just looking at those three colored circles there, and just reading those titles, this is what you should be thinking. You should be thinking, all right, Jim, We've talked about this. We may not have identified them as Basel II, but we've talked about the importance of, look at this, supervisory review. So what are we thinking there? You should be thinking of board of directors. You should be thinking of corporate leadership, right? So we got that whole thing that we've talked about in the past. Market discipline. So what does that mean? That means that we're not going to, as a financial institution, grant a loan unless we've done our due diligence, right? So we're identifying that risk, we're quantifying the risk, and then we're going to manage that risk. And that involves lots and lots of things, including disclosure requirements. Let's look at these pillars just in a little bit more detail. All right, so pillar one. New operational risk capital charge. That sounds like something that we would like. Risk-weighted assets for credit and more risk-sensitive assets. That makes perfect sense. Market risk largely unchanged. We probably knew about market risk before Basel II, and we may have added some things. But boy, we like these credit risk mitigants. We've talked about these at length in previous slides. Supervisory review. So this is not going to be a surprise here. Solvency reports, capital determination, recognizes risks that are not addressed over in pillar one. All right, so things that we've talked about in recent recordings, right? Interest rate risk, liquidity risk, concentration risk inside of each of those silos. All right, how about disclosure? There's that word transparency, capital adequacy, which we spent a chapter on, risk profiling, risk measurement, and management. I mean, this sounds an awful lot like, oh, this is a review of what we've talked about in some previous chapters and previous recordings. Yeah, I like this bottom circle point. If a bank must share information with shareholders, then they will make better management decisions. Of course, that sentence right there has its roots going back to 1958 and the great Franco Modigliani and Merton Miller article, which I challenge you to go back and read. I read it once a year. I think I've told you that before. All right, how are we going to measure credit risk under the Basel II? All right, standardized approach. This is something that we could probably come up with really without giving it much thought, right? External credit ratings. So we're going to rely on Moody's and Standard & Poor's, and maybe our own credit rating model, and then we're going to apply a fixed risk weighting to assets based on a couple of other different variables. What do we like about this? It's simple, doesn't require modeling. It can be uniform across banks. It can be used by all banks, but probably mostly used by smaller banks. What don't we like about it? Boy, I really don't like that second block point up there. Applies a fixed risk weighting. I'm never in favor of something like that unless it's fixed inside of a narrow band. And then you rely on these external agencies, like I said before, unless, of course, then you do it yourself, and then you have some modeling problems as well. Now, if we really want to do it completely ourselves, then we have this internal ratings-based model, and these are based on internal loss models. And so we can do a foundation model, which we did before when we talked about probability of default and loss given default, or we can have our own probability models. So back here, we're probably going to rely externally, but we can add our own internal, maybe cursory input to this standardized approach. But if we want to do it ourselves, then we're going to take ownership of it and do everything ourselves. What do we like about it? It's probably more realistic. And then remember, we had a chapter on the importance of bank holding companies, and so it's probably more appropriate for them. Some things that we don't like about it is that we could go down that value at risk path and maybe make some conclusions that are not risk weighted. Large data requirement, 5+ years, but there are ways of kind of getting around that. All right, how about measuring operational risk under the two requirements? So we have basic indicator, we have the standardized approach, and then we have the advanced measurement approach. So go ahead and look at some of these equations in there. We have an alpha under basic indicator approach. Alpha is a percentage set by the regulators. Over under the standardized approach, we have beta, which is a percentage set by the regulators. But notice the difference. The basic indicator approach is just a basic alpha as applied to the entire institution. Beta then is going to be assigned to each business line. And then the advanced approach, we're going to take total ownership of the system, and we're going to design our own operational risk measurement system. And so let me show you quickly how the math of this works. The basic indicator approach, this is easy. All right, so we got the business lines going down the left-hand side, and we have year 1, 2, and 3. Here's annual gross income. So you just sum those. One of the interesting things here, notice year 1, 80, year 3, 120, year 2 is a -10. So what we're going to do is we're going to exclude any year that has a negative gross income. And so the capital requirement here, now remember, this is based on gross income. So this is the top of the income statement. So we're going to get that 15%. That's given to us, right? 0.15. That's set by the regulators. And all we're going to do is take an average of the 80 and the 120. So there's our capital requirement of 15 million under this basic indicator approach. And so note that makes no distinction between and among any of those business lines. Now, the standardized approach is, of course, standardized based on each individual business line. So we've got our business lines going down the left-hand side, and we have gross income for year 1, 2, and 3 for each of those business lines. So we have gross income for year 1, 2, and 3, and then capital for year 1, 2, and 3. And what we've done here to try to make sure you can not get dizzy by looking at all the rows and columns here, let's go ahead and just focus on year 1. So year 1, retail and banking, we had annual gross income of 10, multiply that by 13%, and we swing over to capital in year 1 of 1.3. So I did that in red, and then for asset management, I did that in, some other color. It's a kind of a blue, right? So year 1 is 10 times 14%, so that gives you 1.4, and then I did it in gold, and then I did it in whatever color that is at the bottom. And so you sum those for year 1 capital, you get 13.6, and then you do the same thing, and I'd left them in the color black. I didn't want to dazzle you with a rainbow there. And so you do the same thing for year 2 and year 3. Year 2 is negative, so we ignore that. So look up at the top. We take the 13 plus the 20, divide that by 2, and we get 17.1 million as our capital requirement. Now that last learning objective asks us for some additional information on insurance companies, because insurance companies, of course, have just a little bit of a difference than a regular financial institution. But there are similarities between and among the 3 pillars. Specifies a minimum capital requirement and a solvency capital requirement. And so look at the second block point. If an insurer's capital falls below the solvency capital requirement, then it must submit a plan for returning it to some kind of a minimum level. For the minimum capital requirement, then supervisors may go ahead and put a halt to the business. Two methods: standardized approach, less sophisticated insurance companies that do not have the capacity to develop an internal model, and then the internal models approach is very similar to the one that we talked about a few slide decks ago. Value at risk, 99.5% confidence interval, and it specifies a capital charge for, underwriting risk, investment risk, and operational risk. And that takes us through those learning objectives. This sounds an awful lot like a history lesson, and so in summary here, what I'm going to say is each one of these is probably important, but we need to make certain that we compare these learning objectives to the learning objectives to the subsequent chapter on regulation after the global financial crisis. Because from my perspective as a test creator, what I would do is I would create an exam question that says, okay, here's a scenario, what happened before it and what happened after it. And so any of these are legitimate questions for that kind of a scenario. So I'm going to throw all of those at you and say, let's go ahead and focus on all of those.